This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making from two Canadians. We are hosted by me, Benjamin Felix, Chief Investment Officer at PWL Capital, and Dan Bortolotti, Portfolio Manager at PWL Capital. All right.
Just the two of us today, Ben.
Yeah, a fairly rare occurrence in recent history, but we have done this before once in your early days.
Yeah. So, looking forward to doing it again. It's a good topic.
Yeah, I think it's a good topic for you and I to do together as well as
I think so.
As we kind of highlighted in the recent AMA discussion.
Yeah, it's something that both you and I have probably come to this question from two different ways, and so it'll be interesting to talk about the ways those intersect.
Yeah. So that main topic is DFA versus Vanguard, which we'll jump into in a second, and then in the after show we have a few new nice reviews that we'll go through. I do have an update on my health with some pretty good news. And then we're going to chat a little bit too about just a reflection on Dan being a co-host of the podcast for 6 months now, which, man, time flies.
Yeah, I thought so too. When you told me 6 months, I didn't realize it had been that long. So it's great.
Yeah. All right. Well, let's jump into the main topic. So most people know Vanguard. I mean, anybody with even a passing interest in investing has heard of Vanguard. They're kind of synonymous with index funds, even though they do manage both index funds and active funds. But they're kind of synonymous with index funds. Fewer people, our podcast audience not included, but fewer people generally speaking have heard of Dimensional Fund Advisors. But the two companies have these connected histories and connected philosophies, I would argue as well. And they both stem from the genesis of the index investing revolution. Vanguard is obviously well known for low-cost funds that track market indexes, which is an approach to investing supported by theory and evidence, as we discussed in a previous episode. And Dimensional similarly applies theory and evidence to portfolio design, but unlike an index fund, they're actually trying to beat the market. Now that sounds good as a theoretical statement, but the obvious practical question is, does it actually work? And sometimes it does, sometimes it doesn't, but we're going to talk about some pretty long-term data here that I think is just an interesting example or illustration of what Dimensional is trying to do and has been able to do. Now, important full disclosure, PWL Capital, as listeners know, uses Dimensional Fund Advisors products in our clients' portfolios. We're not paid by Dimensional. We use their F-class mutual funds, so they don't pay us any commissions. There are no commissions paid to us, no kickbacks, nothing like that. We don't gain anything from sharing this information or discussing this, other than educating people, which I guess indirectly can benefit us if they know that's what we do. And then the other thing I'll say on this, just in terms of thinking about conflicts of interest, is that their products are available as ETFs. So it's not like we're trying to say, hey, this thing is awesome, but you can only buy it from us. You can get them as ETFs. I really think that they're implementing some of the best ideas in finance and investing. I do invest all my own money, liquid money in their funds. Okay, that's the precursor there, or the disclaimer. I don't know what you call it. So the stories, and I think this part's really interesting. The stories of these two companies, of Dimensional and Vanguard, they both start with Mac McCown, who was a founding director of Dimensional, and prior to that was a co-creator of the first index fund. He was a guest on this podcast in episode 182, which was a pretty cool discussion. He has unfortunately since passed away, but he's the guy. Like, it kind of all started there. So Mac joined a quantitative investment strategy think tank inside of Wells Fargo, and in 1964. And he assembled his team of academics to work on quant investing strategies. 6 of the people in that group eventually went on to win the Nobel Prize in Economic Sciences for their respective works. So it was a pretty serious group of people. They didn't know that at the time. I mean, I'm sure they knew they were all pretty sharp, but I don't think they knew at the time that they were all going to go on to win Nobel Prizes. But you look back and it's like, man, that's pretty crazy.
Yeah, they left a pretty incredible legacy. It would have been interesting to be a fly on the wall in those early discussions to see if they had any sense of the history that they were eventually going to make together. So, and separately.
Yeah, it really is crazy. And they couldn't have known because, like, indexing didn't become a huge thing until relatively recently.
Well, yeah, and I'm sure we'll talk more about that, but this was anything but an overnight success. It took,
Right.
I'd say 40 years for it to really become mainstream. It's a long
Yeah.
time. Yeah.
Yeah. And now they all had success academically, that aside, but still, it's crazy to look back and just think like what index funds have become and what all of those individuals who participated ended up doing.
Yeah. Yeah. And I'm sure they would have never seen it unfolding the way it did. Nobody would have foreseen ETFs, for example, as what
Right.
really allowed people to implement indexing strategies more cheaply than ever before.
Right.
So yeah, no, a lot of innovation between now and then.
Yeah.
So
I think it's important to keep in mind, just for context, what was happening around the same time that these guys are working on this. So it's 1964. They're working on what would eventually become the first index fund. There's also this kind of renaissance happening in academic finance that today we look back on as, it's the stuff you learn about in business school, but back then it was pretty new. Harry Markowitz's work on the importance of diversification had come out 12 years prior. Fama's work on efficient markets, which suggested that outperforming the market should be pretty hard, was brand new at the time. And Bill Sharp's work on the capital asset pricing model, which allowed portfolio performance to be largely explained by exposure to market risk, was published in the same year, but he'd been working on it prior to publication, obviously. So all this stuff is happening. And the theory that these guys are working on and the evidence that people were starting to generate by applying what these guys have been working on was really suggesting that the typical investment approach of picking stocks and timing the market was probably not as useful as had previously been imagined, and that maybe active managers weren't doing anything special beyond maybe taking different amounts of market risk and charging high fees for the service, which led them to just underperform pretty significantly. And then the logic that follows from that is, well, hey, if active managers don't beat the market and returns primarily come from market risk, it would be kind of sensible to just minimize costs and capture market returns. And that's kind of where these guys arrived, based on that premise. This group of what turned out to be brilliant people were brilliant people at the time, but we know now how the magnitude of their brilliance. They're all together at Wells Fargo, and they come up with this idea that, hey, we have these indexes. We know that people are underperforming them. Why don't we just build a product that just invests in the index?
what a
Seems
crazy
just
idea.
right.
Yeah.
Crazy idea. Instead of trying to beat the market, why don't we just replicate it and we can minimize the costs? So they did that. They built a large cap index fund that was deployed by Wells Fargo Investment Advisors for the pension plan of Samsonite. It's a funny little detail in the story. The luggage maker. So they had a whatever defined benefit pension plan. They had to invest the assets, and so they engaged Wells Fargo and they deployed the first ever index fund. Now, due to the Glass-Steagall Act, Wells Fargo was not able to distribute these funds to retail investors. So they had this inside of their kind of institutional business, but they couldn't create a product for retail investors. But they kind of realized the potential impact of their innovation. And so they end up giving their research for free to John Bogle, who was eventually the founder of Vanguard, because he was kind of also interested in implementing these ideas.
Can you imagine how they feel about that today?
Right.
That might have been a pretty good idea to have given away. I don't know if you could patent the index fund, but certainly it had a little more value than they ascribed to it at that time.
Yeah.
Yeah.
It really is crazy to
But
think about.
although, that said, as we're going to discover here, it's not like, Bogle profited from that quickly. I mean, of course, he eventually did quite handsomely, but it took a very long time. So,
Yeah. Yeah, it did. But it is crazy. Like knowing what we know now about what Vanguard became, what index funds became, the fact that these guys, these academics who are working inside Wells Fargo just said to Bogle, like, here you go, take it and make something cool, which he did. and then some.
he did.
So yeah. So Vanguard launches the first large cap equity index mutual fund available to retail investors in 1976. Now, the initial launch, as the story goes, was a bit of a flop. They didn't get nearly as much investment as they were hoping to or expecting to. And the index fund was referred to as Bogle's folly for a period of time. But Vanguard has since become, I mean, just a behemoth. They're one of the largest asset managers in the world. They had more than $10 trillion under management when I wrote these notes. I mean, then that wouldn't have changed that much since then. So they manage a lot of money.
You know, I remember the story, and I don't know if it's true, and I also don't know whether it applies to the Wells Fargo version or the initial Vanguard one, but that they didn't actually have enough seed money to effectively buy all 500 stocks in the index, so they had to do some representative sampling. That's pretty amazing. I mean, it speaks to, I guess, how maybe the stocks were not quite as liquid back then as they are today, but still, I don't know. You would have only had to have maybe a couple of $1 million to be able to do that. And apparently, so I don't know if it's not a true story, it should be. It's
I believe it though, because I know that they did get way less than they expected or hoped to launch the fund. So that fits with my understanding of the history too. Now Vanguard is, I mentioned this earlier, they're best known for the index fund products. That's kind of what made them a household name. But Vanguard's also one of the largest active managers in the world. They have around 1.8 trillion of the 10, 1.8 trillion in actively managed funds, which is just an interesting detail about Vanguard. I think people don't realize that they're one of the largest active managers in the world.
they've done a pretty good job of being stealthy about that. Like I think you're right. Virtually everybody identifies them with the index fund. But I think, in their defense, I mean, you could argue they're just kind of playing both sides, but which is fine, but their active funds are the cheapest available. They're only a little bit more expensive than the index funds. And so, as we've said many times, if you're going to make an attempt to beat the market and you keep your costs extremely low, you at least have a fighting chance, right? You're not charging 150 basis points for it. You might be charging 10. And if that's the case, well, then at least you have a shot.
Yeah, it shifts the whole distribution of expected outcomes in your favor.
For sure.
And if you really want to beat the market, you don't have a chance with an index fund,
right?
And you do with a bit of active management.
It's true.
Yeah, but I think their actively managed funds are I don't know, respectable. They're low fee. They're not like crazy high turnover or anything like that. I think they've done a decently good job. Okay, so that's Vanguard. And then Dimensional Fund Advisors, which is led by David Booth, who we have also had as a guest on this podcast. He had previously been part of that Wells Fargo group that created the first index fund, the first institutional index fund. He launched the first small cap fund in 1981. And Dimensional is a lot smaller than Vanguard, but it's still one of the world's largest asset managers. They had over $800 billion under management when I wrote these notes. Probably around the same still. I wrote these about a month ago. Booth's idea when he launched Dimensional was that, and there was no factor premiums back then. That's an interesting part of the Dimensional story. Booth wasn't like, yeah, I'm going to do a small cap value fund because they've got higher expected returns. That wasn't what he was thinking about. He was thinking about, hey, there are a lot of institutions out there like the Samsonite pension plan that have large cap portfolios, just like we built for them at Wells Fargo. They could probably use some small caps to diversify. So I'm going to build a diversified small cap fund be for people that are overexposed to large caps so they can have a more diversified portfolio, look more like the market. Now, small cap funds were expensive to trade is one thing, but then the other thing is there was no small cap index at the time. So Booth couldn't just say, I'm going to track to this index. So for those two reasons, I mean, probably the second one more than the first, because there was no index to track. But even if there was, they probably wouldn't have done it because of the trading costs. So Dimensional didn't implement an index fund. They just implemented this diversified but flexible portfolio that was designed to kind of capture the small cap universe of stocks in the US. It looks a lot like an index fund, like more like an index fund than like a traditional actively managed fund, because it was low cost, diversified, didn't trade much, all that kind of stuff. But it was not technically an index fund, and Dimensional still does not technically make index funds. But I think that's a common perception that index funds are inherently good. Like the marketing around index funds has just been so good for good reason. It's a great story and it's a true story. But I think there's a perception that index funds are good, everything else is bad. But I don't think that's necessarily true. As we just talked about with Vanguard's actively managed stuff, the reasons cap weighted index funds make sense is because they're low cost and broadly diversified, and they beat the vast majority of actively managed funds most of the time. They're tax efficient, they're easy to understand, and they're consistent with foundational finance theory. All true, all super important. But using an index fund is not the only way to achieve those characteristics with an investment.
Yeah, one of the things that I thought was really interesting, and you would know the details better than me, Ben, but if you look at something like DFA's Canadian Equity Fund, it holds way more stocks than even the composite index. Is that right? Like, you could probably make an argument that there's significantly better coverage of the total market with a fund like that than there is with an index fund. Because I mean, with obviously there are exceptions, but the TSX Composite, the best known index in Canada, holds what, 230, 40 stocks, something like that.
Something like that. Yeah.
But there's far more public companies than that. And so there's a lot of things. Now they're very small, but they're left off or left out of the index. So if your fund holds all of the stocks in the index plus another 100 or 200, you could argue that that's a better reflection of the total market.
Yeah.
Right.
Yeah. You could argue that, which may not always be a good thing. I've actually been working on a topic on, I sent you this paper a while ago, Dan, and we're going to have Marco Simon back on to talk about it. But just the way that index funds are implemented, where they trade in an effort to reflect the market, they'll trade stuff like new IPOs. They'll trade based on buybacks. They'll trade based on new share issuance, and sometimes that can actually be detrimental. So the fact that Dimensionals holds more stocks is another reason that they have to be super careful as they are on implementation, because you don't want to rush to buy all the new IPOs, which can have a pretty significant cost drag on portfolios.
Okay. Yeah, and it's so it's sort of pros and cons of
Totally
that approach. Yeah.
Yeah. You'd have fewer issues like that with something like XIC. Yeah. It's really like the edges of the market where there can be some pretty ugly stuff you might want to avoid. Okay, so dimensional launches. We're in 1981. David Booth has launched this thing thinking that, hey, we're going to offer diversification to institutions that are over investing in large caps. And soon after that, Rolf Bonds, who's one of Eugene Fama's PhD students, publishes a paper on the small cap premium. So he finds in that paper that small stocks had systematically higher returns than could be explained by their exposure to market risk. So it's kind of like a happy surprise, I guess, for David Booth, where it's like, oh, not only is there a diversification benefit, but these things might actually have higher expected returns. And then following the small cap premium, research comes out showing other systematic premiums, like where stocks with certain characteristics perform better than kind of Bill Sharp CAPM theory would predict. The big examples are the value premium, which came after the size premium. So stocks with low prices relative to their fundamentals tend to outperform all else equal. And the profitability premium, another big one that Dimensional still implements, that stocks with stronger profitability tend to outperform all else equal. And those findings at the time, they kind of seem to violate market efficiency. One of the papers on the value premium, I can't remember the specific title, but it was titled basically Challenging Market Efficiency, something to that effect, because there was this systematic mispricing. And that's really, there are two explanations. If market risk is what explains differences in returns, and some types of stocks have systematically higher returns than theory predicts, there are two possible explanations. Markets are not efficient, or we need a better model for what an efficient market should behave like. And so that's what led Fama and French to propose a new asset pricing model. So Bill Sharp had his capital asset pricing model, which predicted that exposure to market risk was really the only driver of expected returns. I mean, it was the only driver of expected returns. but that model had struggled empirically. There are all these things like the size premium and the value premium that were kind of breaking the CAPM. And so Fama and French, based on that observation that CAPM was struggling a bit, they suggested in what is now a seminal 1992 paper that in addition to market risk, the unique risks of small cap stocks and value stocks might be needed to explain differences in expected returns. They might be needed to explain how an efficient market behaves. And so that paper, that's 1992 paper. And then they've got the 2015 paper, which is also highly cited from Fama and French, suggesting that, hey, profitability and investment are additional factors. There are still some anomalies out there with this 3-factor model, adding these 2 other factors, which have some like very light theoretical support. Fama is pretty explicit to say that these are empirical models, but they do go through an exercise based on the dividend discount model to explain why these factors do make sense, but it's still not a theoretical model. Anyway, so then we've got 5 factors, and then there's a 2017 paper from Fama and French where they say, hey, this 5-factor model thing, it also works really well in international markets. So those 5 factors, that's the market risk premium, size, value, profitability, and investment. They're able to explain the vast majority, I think it's around 95%, of differences in returns between diversified portfolios. So that means that if we take 2 different funds, say 2 different actively managed funds, or maybe an index fund and an actively managed fund, and they have different returns, and we're wondering why do they have different returns. Most of that difference is likely going to be explained by exposure to the factors in the model. And that's kind of why it's interesting. And it's important because if an active manager has been beating the market just by taking these systematic risks and charging whatever 2% for it, if you can come out with a systematic product that does the same thing for 0.5% or 0.2%, that's obviously a better deal for investors. Larry Swedroe titled the book in 2020, The Incredible Shrinking Alpha. And he's basically just alluding to the fact that what used to look like excess risk adjusted returns, which we call alpha based on Michael Jensen's 1968 paper, that alpha is being increasingly explained by exposures to additional systematic risks. And so that 5-factor asset pricing model today is like, it's the workhorse model in academic finance. So dimensionals have maintained really close ties to academia. Like they're still right in there with Fama and French, but also with other academics like Robert Novi-Marx, for example, that are kind of on the cutting edge of this type of research. And they do have exposure to small caps, but also value stocks with robust profitability. And then they've also built in exclusions. The way they treat investment is a little bit different, but they do account for the investment factor in their portfolios. And those are all designed to give dimensional an edge over market cap weighted index funds. Like they're trying to beat the market. The line between indexing, like Vanguard market cap indexing, active management, like picking stocks and timing the market, and what dimensional is doing is kind of blurry. Like dimensional sits somewhere in between. But I think in what unites them, or the unifying piece between dimensional and index funds, is that taking risk, not picking stocks or timing the market, is what is going to explain differences in returns. The difference is that market capitalization index funds deliver the market risk premium. That's it. That's all, which is fine. And dimensional funds aim to deliver the same market risk premium, but also the size, value, profitability, and in a slightly different way, investment premiums. And the main idea there, or one of them at least, is that building portfolios around multiple risk premiums should increase a portfolio's expected returns. And again, they are trying to beat the market, but it should also increase the reliability of the long-term returns of a portfolio, because different risk premiums will show up at different times. It's not quite diversification. This is always a funny debate in the rational minder community, because some people really want to call it diversification. Dimensional does not like to call it diversification, because increasing the weight of certain types of stocks within the market, you're not adding anything. You're not adding any new securities to say you're more diversified, but you are giving yourself exposure to more independent risk premiums. So is that diversification or is it increasing reliability? I think that's a semantic question that probably doesn't matter much.
Yeah, I think that, I mean, if you think of what diversification is intended to accomplish, it's to make sure that your portfolio is exposed to many different risks and it isn't hugely vulnerable to any single risk, right? So I would agree with you. I think it's just sort of, it's a semantic argument. I mean, you're adding different types of risk to your portfolio or adding multiple securities to the portfolio. It's kind of two different techniques for accomplishing a similar goal. Um, but I don't know. I mean, I trust Dimensional on articulating these things much more than I would trust myself. So,
Yeah, it's a funny conversation because there's even a paper about factor diversification, like saying that the death of diversification has been greatly exaggerated. And they're saying, well, if you tilt toward factors, there's still, so it's not, it's a dimensional quirk, I think, to say that it's not diversification, but it does fit many of the characteristics of diversification. Anyway, semantics, but they pull you in. Okay, so what we've talked about is all pretty theoretical. And I think it brings us back to the original question, which is, has this worked? Is Dimensional's academic approach adding value over the relative simplicity of Vanguard's market cap weighted index funds? Now, comparing Dimensional's performance to a market cap weighted index is still an interesting exercise, but indexes don't reflect fees, transaction costs, foreign withholding taxes for international and emerging markets, and other just real life implementation frictions that a live fund has to endure in order to capture returns. But I think comparing Dimensional funds to live Vanguard funds gives a more realistic investable benchmark. Like, what could you actually have done instead of just what did the index do? It gives us a really interesting laboratory to compare the two approaches. And because they have this long shared history, I mean, other than that connected history being really interesting, I think it gives us a really good setup to compare long histories of live fund returns. So again, as I've mentioned a few times, Vanguard is best known for their market cap weighted index funds. They do also have style funds representing the types of stocks that Dimensional targets, like value stocks and small cap value stocks. So I don't have that many in here, but I will, where I can, compare Dimensional to Vanguard's market cap funds just to say, hey, forgetting about who took more risk and that kind of stuff, because that can get pretty complicated, but just did tilting toward factors outperform the market, which is one of the intentions. But then I also want to look at, where we can, in cases where Vanguard is tilting toward similar factors, how do they compare? How do Dimensional and Vanguard compare? And I think that second comparison on with style funds, it highlights just an interesting point that we'll come back to when we get there. So what we're going to compare is the full histories of matched Dimensional and Vanguard US-domiciled mutual funds with at least 25 years of history. So I kind of just combed through all of their historical funds and pulled the ones with 25 years of history. There's not a survivor bias issue here because they don't close funds.
well, that's interesting in and of itself, isn't it? Right?
Yeah.
A lot of fund companies throw a whole lot of stuff at the wall and, fold all the funds that don't work into the ones that do, and then claim a longer history. Yeah, I can't think of a Vanguard, well, at least, well, this is sort of maybe saying the same thing two ways, but a lot of those funds that have been around for a long time have enormous assets and have not changed their mandates for years, right? So they've had one job and they've done it well.
Right.
They don't launch fringe products, right?
Yeah.
They don't launch trendy products. So you can be pretty confident if you buy a Vanguard fund, you're probably going to be able to hold it for decades.
Yep. True. Generally true. Although they did have a foray into factor investing, and a lot of those funds did close down because I remember I would get a lot of questions about Vanguard's factor products when they were around. They might still have some open, but they had a whole wave of closures in Europe and I think in Canada too, where a bunch of the factor products disappeared. But in general, I agree. They've been super consistent, similar to Dimensional. I don't know if it's true that Dimensional has never closed a fund. I'd have to double check on that, but it's not a common occurrence for sure.
Mm-hmm.
And like their oldest fund, for example, is still open, even though it has not beaten the market, which we'll talk about in a second. Anyway, so we have this big list of funds with past performance, and then the performance ends February 14th, 2025. That's when I prepared the data for this. When I posted the video on this on my YouTube channel, people joked that I spent my Valentine's Day collecting the data, but that's not true. Return data is always available as of the previous trading day. So if I had data as of February 14th, I collected it on February 15th.
Your wife was quick to point that out. Yeah.
I do think it's worth mentioning that this is not a case of just looking at like combing through a database and finding funds with good past performance and then saying like, hey, look, we found funds with good past performance. That would not be that interesting. And we are going to talk about funds that have not outperformed. Some funds are going to do well over any historical period just due to luck. And so kind of combing through the database or data mining those and saying, hey, look, I don't think that's super interesting because there's no reason to expect those funds to continue doing well in the future. And I think anybody should be super skeptical if they see someone kind of touting like, hey, look, this actively managed fund has performed really well in the past. And I mean, hey, skepticism is warranted with what we're about to talk about here as well. But I think what's interesting in this case is that theory and evidence predicted that these funds would outperform the market in the long run many, many years ago. And for the most part, they have actually done that. I think that's pretty interesting. Because like David Booth would have told you, in 1990, yeah, we expect this value in small cap thing to work out over the next 50 years. And we don't have 50 years yet, I guess, if we started in 1990. But we got a lot of years. Okay. So Dimensional's first fund, which is the DFA US microcap portfolio, it has underperformed the Vanguard 500 index fund, at least as of February 14th. So that's since inception, going back to 1981, December 1981. Now, most of that underperformance, when you look at the chart, most of it comes in the last sort of 5 years, where U.S. large cap growth stocks have just been on an unstoppable epic run. So, will that turn around? I don't know. If you look at rolling periods, it doesn't look so bad. It has beaten the Vanguard small cap index fund since the Vanguard fund's conversion from an active fund to an index fund in September 1989. And if we look from that period, September 1989, the DFA fund, the microcap fund, has beaten not only the Vanguard small cap index fund, but also the Vanguard 500 index fund over that period. Shows how important or how sensitive some of this stuff can be to start and end dates. The DFA US small cap portfolio, so slightly larger in size than the microcap portfolio, but we're still in the small cap space. It has underperformed the Vanguard 500 index fund, but outperformed the Vanguard small cap index fund since its inception in March 1992. The DFA US large cap value portfolio has trailed the Vanguard 500 index fund, but beaten the Vanguard value index fund since the DFA fund's inception in February 1993. DFA US small cap value portfolio has beaten the Vanguard 500 index fund and the Vanguard small cap index fund since the DFA fund's inception in March 1993. Now, Vanguard did launch a small cap value index fund in May 1998, and the DFA small cap value fund has beaten it by a pretty wide margin since its inception. We'll try and get the charts for all of these as I'm saying them into the video. And then both funds, the Vanguard fund and the DFA fund, have beaten the Vanguard 500 fund over that same period from May 1998 to February 14th, 2025. The DFA Large Cap International portfolio has outperformed the Vanguard Total International Stock Index Fund since the Vanguard Fund's inception in April 1996. Now, one note on the international, it's a bit of a quirk here. They're both called international portfolios. Vanguard includes emerging markets, Dimensional doesn't. So it does muddy up the comparison a little bit. However, emerging markets actually outperformed developed over this period. So if anything, that should make Vanguard look better not worse. And it would have been, I could have tried to splice together some developed and emerging, or tried to cut out somehow emerging markets, but it becomes really messy really quickly. The
Does
DFA,
dimensional, sorry, I didn't mean to interrupt, but does dimensional's international equity funds always exclude emerging markets or just this specific one?
in the
Um,
US, for the US listed funds, I think that they do exclude them.
mm,
I haven't checked all of their funds to say that that's true, but the ones that I'm looking at here, they do exclude them. In Canada, they include them. It's pretty confusing. Like if you're trying to understand past fund performance, but yeah, the Canadian dimensional mutual funds, when they say international, they have international developed and emerging markets. Their US funds seem to have only developed, and then they have separate emerging markets funds.
oh, okay, that's what I was going to ask. So they don't roll them in together into the same fund. They have emerging markets funds, but you've got to buy them each sold separately, as they used to say.
Yeah, in the
Yeah,
US and then in Canada, they're combined.
right.
Yeah, makes it hard to compare past performance if you don't really dig into like what's actually inside of the funds. And then Vanguard calling it international, but including emerging markets, like that's also a little bit confusing. Fund names can often be very misleading. The DFA International Value and Small Cap Value portfolios have beaten the Vanguard Total International Stock Index Fund since the Vanguard Fund's inception in April 1996. Same thing with the emerging markets there. They actually outperformed over that period, which would have helped Vanguard out a little bit. In emerging markets, the DFA Emerging Markets portfolio beat the Vanguard Emerging Market Stock Index Fund since the Vanguard Fund's inception in May 1994. And then Dimensional goes on to launch 3 more emerging markets funds, which have all gone on to outperform the Vanguard Emerging Markets Stock Index Fund. And then the last one I'll mention here is the DFA US Targeted Value portfolio. It has like pretty seriously outperformed the Vanguard 500 Index Fund since the DFA fund's inception in February 2000. Now that's we talked about, I mentioned the sensitivity to start and end dates earlier. Like if we look back in time now, we know that was either the worst time ever to invest in US large caps or the best time ever to launch a small cap value fund. So take that for what it is, I guess.
Yeah, if you have move that start date to 2010, I'm
Right.
guessing you're going to get a different number.
That's
Still
exactly
over
it. Yeah.
15 years. Yeah.
Yeah.
Um,
Yeah. I do want to mention, I did look at, based on a comment on my YouTube video on this, I did look at rolling period performance over 5-year periods. I don't have that data in front of me right now, but it was all very favorable. Like it was all over 50% of rolling periods, typically well over 50%, that the Dimensional was outperforming.
yeah,
That
and
is,
you've compared a lot of these to the Vanguard 500, which tracks the S&P 500.
right.
And it's maybe worth stressing just how difficult that index has been to beat, since its creation, but certainly in the last 30 years or so. Anybody that can beat the S&P 500 with a US fund has done incredibly well and would be in a
Yeah.
very, very small group, right?
Yeah. Yeah, that's very true. Now, one thing that jumps out, I think, in those comparisons is that Dimensional's performance has generally been better in international developed and emerging markets than it has in the U.S. market. And I mean, that speaks to what you just said, Dan, that just U.S. large cap growth stocks or large cap stocks more generally have just been nearly impossible to beat for anybody. I was doing some research a while ago looking at just trying to look for really good managers that had major flameouts. And so many of the really interesting stories are value managers who over the last 10 or so years have just not been able to keep up, and they end up closing down based on underperformance. Now it is well documented, and we talked about this briefly after we had Andrew Chen on. Andrew Chen basically says there are no more anomaly premiums in the U.S. market when you account for costs. But there's other research showing that while that is true and that is fairly well documented, that premiums have been pretty muted in the U.S., outside the U.S., they've actually been quite strong. So we see that in the performance of Dimensional's funds. But to your point a second ago, Dan, it is still pretty impressive that Dimensional has had some outperformance in the U.S. market over that period. Whether the factor premium thing, like whether the performance of U.S. large cap growth and the underperformance of factor premiums in the U.S. is a permanent structural change, which is what Andrew Chen argued, or is itself an anomaly that we're seeing like anomalous high returns for large cap growth stocks? That's something we can't know. Time will tell. But it is interesting to look at the U.S. market today. Valuations have come down a little bit since I wrote this, but valuations are still pretty high. And the last time, well, they were higher, quite a bit higher now, or then than they are now. But in the year 2000, when valuations were super high, we could have been having the same conversation, looking at how poorly value and small cap value had done relative to the market. And then, as everybody knows, that reversed fairly aggressively. And there's, I think I have an example in here. No, maybe it comes later. So I think overall, Dimensional's ideas are impressive, and their implementation is impressive. And the fact that they've done pretty well by taking this academic research that says like this, hey, this stuff kind of should work, and Dimensional has shown that it actually can, and actually does. I think that's pretty cool and pretty interesting. And it suggests, I think, that insights from academic finance are not just kind of curiosities. They're practically useful to investors, beyond the big insight that, hey, you can't really beat the market very easily, at least not without taking on more risk. But Dimensional has shown that there are maybe other risks that you can take that can pay off in the long run. And then another insight that I think is interesting that comes from these data is that whether it's Dimensional or Vanguard, because keep in mind, Vanguard has these style funds too, tilting toward styles like value and small cap value can actually have merit. Like there are periods where, we've talked about this before, Dan, there are periods where factors suck for a long period of time, but there are periods where the market sucks for a long period of time too.
Mm-hmm. Yeah. And I think to that point you just made, if your goal is to try to access those factors and implement them in your strategy, I would argue you're better off going with Dimensional than you are with Vanguard style funds, for example.
Yeah.
Dimensional, whatever your preference is versus, market cap weighting versus factors, it's pretty hard to argue that this is a company that takes implementation of these ideas extremely seriously, and they do a phenomenally good job in doing it, right? So you're not like, if you are going to see, say, underperformance in a Dimensional fund compared with a cap-weighted benchmark, you're not going to see it because of poor implementation. Right. You're going to see it because the factor premium didn't show up during that period. Yeah. And that's not something you can say about any fund company.
Yeah.
That's, yeah.
Yeah. Yeah. I mentioned that idea of index funds trading into stuff that has low expected returns and out of stuff that has high expected returns, like kind of around the edges of the market when the composition of the market changes. So that Marco Salmon has this paper showing that costs index, and it requires some explanation, but that costs index investors, they find between 32 and 81 basis points relative to what is the question. So the way that they measure that is that they have an index fund strategy that rebalances in the same way that an index fund would, so quarterly on a calendar basis. And then they compare that to an index fund that delays rebalancing. So it rebalances daily with a rolling look back period, and the look back period determines how long they'll wait before implementing changes to the market composition. So like if there's an IPO, if their look back period is a year, they're not going to add that IPO until after a year. And so they compare the real life version of an index fund, like the quarterly calendar rebalancing, to these various look back periods. And they find that the longer you wait to implement those changes to market composition, the higher the returns of the index fund are. All that to say, just on implementation, Dimensional does have a total market fund that is designed to not give you any factor exposure. It's designed to give you the US market return, but they implement it the way that they would implement any other Dimensional fund. So it's flexible. It doesn't track an index. It doesn't rebalance on a specific day, which can have effects on the price that you pay for securities and that you sell securities at, and it doesn't jump into IPOs, all that kind of stuff. And so because I was looking into this topic, I looked at the performance of that fund versus VTI. The Dimensional Fund has a 9 basis point fee. VTI has 3 basis points. But since it listed as an ETF in, I think it's March 2021, and it's outperformed by about 35 basis points annualized over that period, which is almost exactly what Marco's paper predicts, which is just that's probably noise, but it's kind of neat.
Yeah, it's interesting noise though, isn't it?
Yeah.
And I've had this discussion, with clients and other, or people who are kind of more into the theory of it. And I would totally agree. No, when indexes were created, I think it's important to remember when indexes were created, they were not created as an investment strategy.
Right.
They were created as a benchmark of the overall market, and they did an extraordinarily good job at that. It was only much later that people looked at them and said, hey, what if we bought the market? And if you're going to buy the market, what do? Buy all the stocks in the index in the same proportion. And so there are some frictions based on that. And those are real for sure. Yeah. Now, I think you would argue compared to the costs of most active management and
100%.
compared to the high costs of most other alternatives, the index fund is the best of the bunch. But in theory, if you could take all of the good things about the index fund and tweak at the margins to get rid of some of their faults, which is exactly what you're saying Dimensional is trying to do. If you can do that successfully, it wouldn't surprise me if you saw some modest outperformance. But the danger is there are lots of, I can't think of a specific example, but there are definitely fund companies who have tried to do this. I'm going to start with an indexing premise, but I'm just going to make a few tweaks here and there, and they backfire.
Yeah.
So you have to be very careful about what those tweaks are going to be. And if you are skilled at it and you work on the right things and you trim in the right places, it wouldn't surprise me very much if you got a little bit of outperformance at the margins.
Yep. Yeah. I would love to see other fund companies see Marco's research, hopefully get some traction, and see that like maybe we don't have to exactly follow the index. Why don't we just build a fund that is a total market fund, but not an index, and track something like the total market, but implement a little bit differently, which is what Dimensional has done. But it seems like, I guess there's not a lot of margin in it, which is maybe why we wouldn't see a bunch of, because as soon as you add margin for the fund company, all of the benefits go away.
Well, that's exactly right. Like you could pay somebody to do all that work, and that's going to have to detract. And then at what point does it become counterproductive? I don't know. For most funds, it is counterproductive.
Yeah, exactly.
Right?
Yeah. Anyway, I've written most of that topic, so we'll do a future episode on that. That'll be a fun one too. Anyway, so we've made this all sound pretty rosy, that these academic ideas work and Dimensional is outperformed in the long run. That all sounds pretty good, but there's an important downside to Dimensional funds, which is that they're going to perform differently from the market over time. And we talked about this a bunch in the AMA episode, Dan.
Yeah.
They're exposed to different risk premiums. Different risk premiums pay off at different times. I mentioned that a minute ago as a benefit, which I think it kind of is in the long run. And you should, or maybe it's reasonable to expect a small benefit for taking on those risk exposures. But just like there can be periods of outperformance, there can also be periods of underperformance, like, as we just mentioned, the recent history in the US market, where tilting toward value and small cap value really sucked. Over the last 10 years, again, this is ending February 14th, the DFA US small cap value portfolio has trailed the Vanguard 500 index fund by 4.5 percentage points annualized for 10 years.
It's a big gap.
That's no joke.
It takes a very patient investor to endure something like that, right? We all know how impatient most people are, most investors are. They lose the confidence in a strategy that is quote unquote not working, after a year or two, let alone 10, and 10 by a pretty significant margin. So you need to be in it for the long haul, and don't don't underestimate how difficult it is to hang on to that strategy when, it underperforms for 10 years.
Yeah. Now that has happened before, worse even. So from its inception in 1993 to February of 2000, the DFA US small cap value portfolio trailed the Vanguard 500 index fund by 6.3 percentage points annualized. So I guess it's not quite as long, 7 years, but by more underperformance on an annualized basis. Now in that case, David Booth used to joke that, he probably still does joke, that they have a knack for launching products right before they go out of favor. So they launch the small cap value portfolio and then it just gets smoked for 7 years. But in that case, things did turn around for small cap value when the dot-com crash happened. Small cap value stocks went on to deliver annualized returns over 9% annualized through the so-called lost decade in the US, while the US market was effectively flat. So periods of pain, but then we get a decade of basically a 9% excess return. Now, it is important to remember that while they've struggled in the US, value and small cap value, they've still performed relatively well in markets outside the US in recent history. And over past periods of small cap value outperformance in the US, at least in the data presented earlier in this video, dimensional funds have been able to capture more of the premiums than Vanguard funds with similar styles. So kind of to your point earlier, Dan, when these premiums do deliver, and it's not just implementation, dimensional also has more exposure, like they own smaller and cheaper stocks than like if a DFA and a Vanguard small cap value fund are almost not even comparable because dimensional has so much deeper tilts. That's just a product decision. And then the implementation is another piece of that. They do that efficiently, but it's also just much different risk exposures. So I think if you want those risk exposures, dimensional does a really good job delivering them. Now I can't tell you how the current period of US underperformance is going to play out. We do know that despite those two historical periods that we just talked about of pretty extreme pain for extended periods of time, the US small cap value portfolio has beaten the Vanguard 500 index fund over its lifetime. So, no pain, no gain, I guess. But it's pain. It's not a joke. They're called risk premiums for a reason. Sometimes it sucks to pursue them. That's kind of it. So Dimensional and Vanguard are these two fund companies with really connected histories that I think is pretty interesting, that stem from the development of the first ever index fund. Vanguard's market cap weighted index funds have been nothing short of revolutionary, and I don't think that's hyperbolic at all for investors, and they've become synonymous with sensible investing for good reason. Dimensional took implementing the ideas from academic finance a few steps further than Vanguard did, and they're lesser known, and that's partially their own doing. Like, they don't really market much. I guess Vanguard doesn't really either, though. Anyway, so they're lesser known. They've got this impressive track record, but kind of nobody knows who they are unless you're a finance geek. Through a lot of Dimensional's history, the funds were only available to institutions. They started out as an institutional manager or to retail investors through financial advisors. That was their next iteration so they said, okay, we'll move away from institutions, but we're only going to go through advisors. And that at the time was to limit cash flow volatility going into and out of their funds. They didn't want to deal with managing portfolios with performance chasing behavior from investors. So they thought advisors could shield them from that. Anyway, they started launching ETFs in the US market in 2020, and they've now got a full suite of their strategies available as US listed ETFs. And then of course, Avantis also launched ETFs in 2019, also US listed. They do sub-advise some funds for Manulife that have ETFs here in Canada. Not crazy about them, but they are out there. And then of course they have their mutual funds in Canada, and those are still only available through advisors for the time being. I would definitely say it's not worth paying a financial advisor's fee for access to Dimensional funds. We've gotten that call a few times where someone's like, hey, I want to pay you either your normal fee or a discounted fee or whatever just to invest in Dimensional funds. And we reject them every time because it just doesn't make sense. I mean, even if based on our expected returns for the factor tilts, they're not huge. I think it's like 40 basis points or something. So I mean, if you're paying even 30 basis points in fees to own that, additional fees, it's not going to make a whole lot of sense. The actual fees on dimensional funds, their 60/40 global portfolio, based on the most recent MRFP, is down to 28 basis points, which is pretty good.
Comparable to the asset allocation ETFs by
Right.
iShares, Vanguard, BMO.
Yeah,
Yeah,
they're on the
it's
same.
in the same ballpark.
Yeah.
Yeah.
Yeah, so I wouldn't pay an advisor just for dimensional funds, but I think it is worth finding one that either uses or could use dimensional funds. Like, I think it's, if someone comes to you, Dan, you know the literature. I mean, you guys have access to dimensional funds if you wanted to, but you have the knowledge base that a dimensional advisor would have. And I think that's really what investors should be looking for when they seek out financial advice.
Yeah, I think like anything else, you're going to want your advisor to understand the investment strategy and the products that they use really well,
Yeah.
right? And I think you're right. Like if you were able to access dimensional funds through an advisor who just saw them on a huge menu that included a lot of other garbage,
Right.
it's the wrong fit. I
Right.
think, and I don't know what, I'm sure there's no sort of exclusivity contract, but if you're an advisor who is kind of on the approved list, my guess is you're using dimensional funds, if not exclusively, pretty close to exclusively, because you just believe in the strategy, and it's not like I'm going to make this 5% of my portfolio. I'm going to use it as my core strategy.
Yeah.
And yeah, and I would respect that. If you're going to do it, you need to understand the details, and then you need to just carry it out with confidence, because otherwise you as an advisor end up being in the performance chasing category here, where you
Yeah.
say, hasn't worked for 5 years, I'm switching gears. That doesn't help anybody.
No. Yep. Agree with all that. Should we move on to the after show?
Yeah, let's do it.
All right. So I got a quick cancer update. I went for CT scans. They injected iodine into my blood, I guess, so they could see tumors better. But they were all clear, which was great. And I just got that news last Thursday, which feels like I got the news a long time ago. I don't know. It feels like my whole life changed, and I felt just a weight off my shoulders. But yeah, it was only a week ago that I found that out. So that was good news. So basically, like, the surgery got the cancer that was in there out, and there was no sign of spread when they did the surgery, and then these CT scans have confirmed that there is no spread as of now.
Well, that's fantastic news. I think I can speak for everybody in the audience when I say that's excellent news. So you're feeling a little bit more. I know from talking to you before, it was like the uncertainty is the hardest part to deal with, right? And now, yes, you got some news, and it's about as good as it could have been. So that's excellent.
Yeah, it kind of felt like everything was on pause, sort of, like, until I kind of knew what was going on there. Yeah, so definitely a weight off my shoulders. There is still this cycle now of blood work every 3 months, CT scan every 6 months for the next year, because there is still a 15% chance of recurrence based on the type of cancer and stuff like that. And so if that does happen, then I would still need chemotherapy, which would be highly effective. Like, they order it this way. I could have elected to do chemo, but they recommend doing this. They call it active surveillance, because if it does recur, chemo is still just as effective later as it would be now. So it's like, I've got this 15% chance of recurrence for the next 5 years. But if it does recur within that window, I can do chemotherapy, and it would still be just as effective as if I did chemotherapy now.
Yeah. So very little or no benefit to doing it kind of proactively.
Exactly.
Yeah.
Yeah, exactly.
Yeah. Well, that's not something anybody wants to go through unless they have
Yeah.
to, right? No, it's dreadful, right? So,
Yeah.
no, that sounds great.
Yeah. They give the option because I guess some people want to just be done with it. They also explain that some people, for whatever reason, are not able to do active surveillance because they live far away from a medical center, for example. Anyway, so that's what I'm doing. I'm doing active surveillance, keep an eye on it for the next 5 years, and then after that, I'm considered a regular person again.
Excellent.
I did want to touch base, Dan. It's been 6 months, as we talked about this briefly in the intro. 6 months since you started co-hosting the podcast. I just wanted to know, like, what do you think? Are you enjoying it? Just what are your thoughts?
It is really great to kind of be back behind the mic and to be able to speak to a much wider group of investors than I'm able to do kind of just on my own. I still communicate with investors when I hear from them directly, but obviously the numbers have slowed down as I have not been creating any content, the way I used to. Um, I'm sure like your listeners will know. I mean, I had my own podcast there, the Canadian Couch Potato podcast for, geez, I can't even remember how many years. It wasn't very long. We did about 24, 25 episodes. And this was going back, right? Like it was 2015, I think we launched,
Yeah.
which, 10 years ago, the podcast universe was a lot smaller than it is today. And it was great. I loved doing it, but it was just an extraordinary amount of work. When I started doing it, it was, I don't want to say totally a one-man team, but it was close in that
Hmm.
I took a different approach than you do. Like I wrote the scripts word for word. And so I was booking interview guests myself. I was writing all of it. I was recording it myself, sending the files off to a producer who edited it and add the music and that. But I mean, to produce a 45-minute podcast probably took me 10, 12 hours. And I was
Hmm.
doing it on the weekends, right? Because I just don't have time to do that during the workday. And it was taking its toll for sure. And it got to the point where even though I loved doing it, and I think it had a pretty loyal audience, it was not practical for me to continue. And I remember, I mean, you and I talked about this. We were at a dinner, and I guess you'd basically said, "Look, if you could do it without all of that prep work, are you still interested in the idea?" And I said, "Absolutely." And here we are. It's such a tight ship here. I mean, it's such a great team in front of the mic and behind the scenes. So much amazing research and prep that goes into it. It makes my job relatively easy, and my role, I feel it's kind of share my experience, share my whatever wisdom I may have gained in the trenches over the years. Um, and I really enjoy it. And I hope listeners feel I'm adding something to it as well.
Yep. No, you definitely are. I mean, I've loved having you on, and we hear from listeners. I know you don't go on social media as much, but we definitely hear a lot from listeners that you've been a great addition. So yeah, it's
Excellent.
good.
Thank you.
All right, should we do some reviews?
Yeah.
All right, I'll start. Best finance podcast, super interesting and informative. This podcast, as well as Ben's YouTube channel, led me to question the financial advice I've been getting for most of my adult life. Became a PWL client last year, and I couldn't be happier. Keep up the good work. By B. Smith from Canada. Very nice.
All right. Here's another one that's titled Great Way to Learn. Been a regular listener to every episode for the past 2 years, and AMA number 4 was my absolute favorite. I'm getting close to retiring, and I love the discussions on factor investing and sequence of return risks. Thanks for your expertise and entertaining discussions from Cordillera in the United States of America.
Nice one. Fantastic. I mean it. That's good. I'm glad they actually meant it. I cannot recommend this podcast enough to anyone interested in seeing how the sausage is made in practical terms. Having listened to every episode at least twice over the last few years, wow.
That's a lot of listening.
Wow. It's given me the confidence to save, invest for retirement, and get my financial house in order and keep it that way. Probably most impactful thing from these episodes was the understanding and confidence of how employer matching/fund selection can impact employee retirement. Based on the education provided within, I approached my company HR about our 401k funds to have access to better options. In an interesting turn of events, I'm now on the 401k committee, and we've recently gotten lower cost index and target date funds approved for everyone in the company. You have literally impacted thousands of people in a positive manner, and I can't thank you enough for the work that you do. That's from Mike from the United States. That's pretty cool.
That's an amazing story because, I've heard this a lot. People will say, talk to your HR department and see if you can get them. And I'm thinking that's never going to work, right? I'm just thinking I don't know what kind of an audience you're going to get with the people who make these decisions. And you could make some argument that isn't really going to resonate with them. This is fantastic. That, this is a real example of someone who actually did it successfully. So,
and got on the committee. Like that's good.
Yeah.
I mean, good for Mike. That's credit goes to Mike for pulling that off. Not just us.
I'm going to start giving that advice again. I sort of stopped doing it because I thought it was futile, but apparently not. That's excellent. So, all right, our last one here just says top tier podcast. Excellent discussions on financial topics with sometimes too much research and evidence to back it up. Fair enough. Love nerding out over super niche topics and getting into the nitty-gritty details. The AMAs are a good opportunity for you all to dive into more regular, everyday people issues, which is a good break from some of the super specific topics that are only applicable to high-income individuals or corporations. Been listening for around a year and trying to catch up on the backlog. Keep them coming. From RD 2001 in Canada.
Very nice.
Good feedback.
Yeah, good feedback. We always appreciate the reviews. We didn't have some, I think last time we recorded, we didn't have any maybe. And so I said, hey, why don't you leave a review if you haven't yet? And then we got all these new ones. So hopefully we have some more next time. All right. Anything else?
Okay. No, I think we're good.
All right. Thanks, Dan. And thanks everyone for listening.
Thanks. See you next time.